The audit. I don't think we finished monetary unit sampling. Maybe we did. I'll have to take a look at it. I thought we still had one more to do on it.
Yeah, we didn't finish that one.
We didn't finish. Okay. And sampling overview. This we might just finish this. I don't know. We might get it. We'll see if we get the sampling overview. We'll get partway through chapter 6 anyways. Chapter 6 is actually kind of a big one. Hopefully you have it. Looks like this. Okay, so this is kind of the audit process overview. Well, I should ask, but is there anyone that doesn't have the chapter 6 handout? Okay. So this is going to be chapter 6 right here. Planning the audit. Some of the stuff we actually do in chapter 6 too, but the internal controls, this is chapter 7 and 8. I guess my point being is these are not going to be all the same in chapter 6. Complete the audit, obviously, we're not going to do that in chapter 6 is planning. And then forming an opinion. So the chapter 6 is really about this one for the most part. A little bit of the other stuff. Okay, so planning the audit. Now, basically, everything in accounting can be boiled down to 5 general types of accounts. So revenues are money coming in, expenses are money going out. Assets, stuff that has a value. Liabilities, stuff that we owe. Put this in. And equity, which is what is owned. Coming in, this is money going out. So anyway, so these are the 5 basic types of accounts. Now, the question is, which type of account is easiest to prove? Is it revenues, expenses, assets, liabilities, or equity? So which one of these types of account, I should say type of account? Anyone? If you had to prove something existed, which would be the easiest one to prove that something exists? Anyone?
Would it be revenues?
Not usually revenue. It's usually going to be what revenue brings you. Cash, for instance, you get bank account. Inventory, you can go take a look at inventory. So actually the first one.
Oh, cash, you're asked. Yeah, okay, yeah, that makes sense.
No, oops. Now, that does come about because of the revenue coming in goes into cash. We'll talk about this in a second. But, yeah, so the easiest one to prove is going to be, I don't know, I should make these different. So this will be the, let's make it green. So the easiest one to prove would be assets. Probably the second easiest to prove is going to be the liabilities. oops. That, because there'll be payments being made for these. So you can simply look at the payments, look at the checks going out of the payments and look at the bank statements. Now, here's the beauty of auditing. If you can prove the, oops, not that. If you can prove the assets and you can prove the liabilities, well, we know that these two sides equal, right? So, you know, if the assets equal liabilities plus the equity, come down here. Okay, so coming down here, if we know that total assets equal liability percent, well, if we can prove these two, then by default, we know this one, right? If these two are okay, if the assets are okay and the liabilities are okay, then the equity must be okay. And notice that the equity through the statement of the retained earnings will have the income. Now, if the income is okay, we know that the revenues and expenses, or at least the difference between the revenues and expenses, are okay, right? This is money coming in. Oops. That was unfortunate. And this is money going out. You know, that's going to equal our income. So if we can prove liability, assets and liabilities, we know equity is okay. If equity is okay, we know the net income should be okay too. Now, these two accounts, you know, if you overstated revenues and you overstated expenses by the same amount, it'd come up with the same income, but you know that the net income would be okay. Okay, so assets are the easiest to prove. And we'll go a little bit further here and we'll concentrate on cash. Now, cash is very often the smallest account or one of the smallest accounts on the balance sheet. In fact, it's so small that you might say that, you know, if you looked at it simply by the dollar amounts, you'd say, okay, you don't even need to audit cash because it's not material. Okay. Now, the thing is, virtually everything runs through cash. And so one of the reasons why we really beat up the cash account when we do auditing is that while we prove cash, and cash is one of those things you can prove to a large extent, a lot of times you're proving the revenues. Right? When cash comes in, you know, when revenue, someone pays for something with cash, it affects the cash account. You say, well, what about if they buy it on credit? Okay. If they buy it on credit, it goes into accounts receivable. When they pay it, it goes to the cash account. Right. So while you're proving cash, you can actually prove almost every other category on, you know, on the financial statements. Yeah, how about liabilities? Okay, well, or expenses, let me scratch that. Expenses. Well, expenses, you pay them in cash. It just goes right to cash, and you go, okay, well, what about if you don't pay it with cash? Let's say you pay it with you know, you buy it on credit. Okay, so well, you guessed it. When the accounts payable are paid, it goes through cash. So basically, everything on the income statement at some point in time is going to go through cash. And even these other accounts, you know, inventory, even if you buy this on credit, you know, it's going to go through cash. And so almost everything goes through cash, and cash is an asset that we can actually audit to a very high level. In fact, oftentimes 100%. So when we do our auditing, we focus usually on the assets at first. Anyways, the assets are the easiest to prove. So the easiest to prove. That's the assets. And among the most important ones there is the cash. Even though it might be fairly small, everything goes through cash. So if you can prove out cash, that you can also prove out these other accounts. And cash is, like I say, is one of those things that a lot of times you can prove out almost 100%. And the reason why is bank accounts. You know, if you have a bank account, you get a bank statement, right? Every account has a bank statement. So it's not impossible to do 100% cash. In fact, a lot of audits do. They do 100% cash. They'll audit cash at 100%, but because they can get the bank statements, and the bank statements, they can get the bank statements sent directly to the auditors, so that the you know, whoever their client is doesn't even get a chance to alter the bank statements. So a lot of times we can do cash at 100%, and this can really prove out the rest of the audit. Okay. I should tell you something else about auditing, and that is, we show you this stuff. It doesn't mean when you go on an audit that you're gonna have to know all this stuff. So if you get to audit cash, you know, oh, I don't know everything about auditing cash. There are audit plans, audit programs for auditing cash, and you follow the steps. And a lot of times people talk about how they, you know, discovered fraud or whatever it was. Oftentimes, if you just follow the steps in that audit plan, it's a step-by-step approach, you'll get there. So it isn't like you have to be some mastermind, know everything about auditing. There's the audit program. Now, that audit program or audit plan that we're going to talk about, that is what you use. You know, those are the steps you use to go through the audit. You know, the methodology of going through the audit and making sure that you cover everything you need to cover. But again, it isn't like I'm going to do auditing, I have to know all this stuff. I have to know how to audit cash and inventory, all the steps and all that. Generally, you don't. And most any place you start working, they're going to have their own plan that they use. Now, you may alter it a little bit. You may say, well, we should really do this instead of that, whatever it is. But anyway, you do not have to have all, you know, all the knowledge in your head, basically, when you walk in a job to audit cash. There's going to be an audit, a plan, you know, and kind of a program and the steps that you go through. And that's what we're going to talk about a little bit later on here. But don't think you have to, you know, the auditing is memorizing all these, you know, 30 steps for auditing cash or whatever. Okay, risks. We may have talked about these. I think we did, but inherent risk. Is a risk that a material misstatement will occur. Okay, so inherent risk. This is a risk that a material misstatement will occur. So for instance, if we're just talking about errors, what are the possibility of an error happening? And inherent risk can be kind of a little bit funny in that, you know, generally you think of, okay, someone who's new, is less experienced, may be more likely to make a mistake. However, someone who has been there many more years was probably more likely to do a fraud, you know, so do some kind of fraudulent act. So, you know, inherent risk, while it does lose a little bit based on experience, at the same time, someone who's new probably isn't going to do fraud, where someone who's older might. Someone who's older probably won't make a mistake, where someone who's newer on the job might. So, control risk. Okay, any question on inherent risk? So this is the will a mistake or a fraud occur? The second one, control risk, is a risk that the clients Internal controls. Oops. By the way, did we already talk about these? I can't remember.
No, not to my knowledge.
Okay. Okay, so control risk is the, I gotta mess this up here, hold on. The clients, so that now this is the client's internal control. So for instance, this is like IBM. You know, for instance, IBM's internal controls will fail to detect or prevent a material misstatement. So this is the clients, not the auditors. Oops. Okay, so inherent risk is the risk that a material misstatement will occur. Control risk is the risk that the client's controls will fail. Now, these first two kinds of risk, these are entirely under the client's control. The auditor does not control these. So the auditor does not control these two risks. We don't control whether the client might have a material misstatement that'll occur either through mistakes or through fraud. We can't control that. If we could, ought it to be really easy. Come to knock it off and you'd be done. Control risk. Again, we don't have control over the client's internal controls. And you may say, well, wait a minute. If there's a problem with their internal controls, can't we tell them about it? Well, yeah, you will. But realize what has happened is that those controls were in place during the year. So those controls were in place in January. So let's say you get to the end of the year audit, like December, you find some problems with internal controls and you make suggestions and the client changes them. Client says, okay, yeah, we'll change those controls. There's still a problem. The problem is that you had, for instance, sales in January, February, March, whatever. So there are parts of the financial statements, for instance, especially the income statement, revenues and expenses, that those controls didn't exist. And even inherent risk, you can say, okay, you guys can do this to reduce inherent risk. Again, we can't jump in the time machine and go back to the beginning of the year and put those controls in place and run the whole year again. So those first two risks, the auditor cannot change those. The actual risks themselves, the auditor cannot change. If you run into a CPA questions where they say the auditor should change the inherent risk to this or change the control risk to that, you know that those are no good because auditor can't change those. They can't, we don't have a time machine and to go back in time and change those things. So we do evaluate those, and we might change our evaluation of the internal controls. Say, okay, we thought they were this, they're actually better or worse or whatever. But the actual controls themselves, we have no control over. All right. Yeah, it is. Sorry about that. I think I'm gonna sneeze. I got my allergies are really kicking in. So if I ever turn my camera and microphone off, I'm probably sneezing. Okay, detection risk. Is a risk that the auditors will fail to detect a material misstatement. Okay. So detection risk is the risk that the auditor. So this is the one that we have control over. Detection risk, this is where auditors come in. This is you know that we might clean this one up a little bit. Get a better word for control. I'll say manage. But I want to get. There's a problem here that control is down here and then detection is also there. Okay, detection risk is the one that auditors can manage. So this is the only one that, as an auditor, we have some control over. You know, we can audit to say we can audit to the 90% level. You know, to the 95% level, you know, 99% level, whatever it is. We do have some control over this detection risk. Okay, down here, audit risk. This is if everything fails. A material misstatement occurs, controls fail to catch it, the auditors fail to catch it. It ends up on the financial statements, and that is the audit risk. Audit risk is a risk that an undetected, so it's a risk that an undetected material misstatement will appear on the financial statements. Okay, so audit risk is the risk that an undetected material misstatement will occur on financial statements. And I'm back. Okay, so yeah. So if these three occur, so it's sort of like this is the end result. If everything fails, you know, you end up with this risk here. And that means that the audit has failed. That the audit is ineffective. The audit did not do what it was supposed to do. Okay, so these are the types of risks. And again, these first two, we simply assess. As auditors, we assess these. Oops. Hold on a second. So auditors assess these risks up here, these first two, auditors assess those. Down here, we have some control over it. We control the detection risk, and then finally the audit risk, and that's the risk that the audits are not effective. Their undetected material misstatements are on the financial statements. Okay, and here is a kind of a formula for coming up with the audit risk. You basically multiply them all together. So, for instance, if we have inherent risk of 40%, these are kind of high, but you get the idea. So inherent risk is 40%. There's a 40% chance that a material misstatement will occur. 50% chance the controls will miss it. And 20% chance that the audit will miss it. So you multiply these together. And I know they've had this on the CPA exam before. I don't know how recently, but point two. And that will equal our audit risk. Time for Mr. Calculator. I think it's 0.04. We want to check that. So that would be audit risk of 0.04. Or there's a 4% chance. Oops. Yeah, so you multiply those together. Oops. And come up with that. I think that's right. Okay. So this is how you can actually mathematically come up with. I don't know if any audit firms actually do this, but it has been on the CPA exam. I know that. I think it's been on at least a couple of times actually. Okay. Question on that? So these are the risks, and again, we assess the risk of here that something bad will happen and whether or not the controls will catch it. And
So as far as the percentage wise, if the lower the percentage, how, like say if that was a higher, say if that was like 8%,
yeah,
would that be more riskier? I'm assuming yes, right?
yes, that's an excellent question. For all these risks, you want them to be low. So you always want the risk to be low. However, it is possible that you can adjust your risk depending on what the inherent risk and the control risk is. So, for example, let's say that you, oops, not that. Get back here. Okay, so let's say that you wanted to have 4% risk, right? And so you said, okay, we want audit risk to be 4%. It is possible. Now, the only thing you can control is this one. Let's see here. So let's say that you said, okay, we want, this is what we want, desired risk. This is the desired risk. This is what we are, our goal, our target, our tolerable amount, whatever you want to call it. And let's say you go do the, you walk through here and you do this. You come to this control risk and you go, you know what, the control risk is actually only 25%. There's only, instead of a 50% chance that there's not a 50% chance of control risk, there's only 25. But only 25% chance that the controls are going to fail. We do our testing and we come up with this, gee, they made improvements on the internal control or whatever it is. So here is the question. What does your detection risk have to be to get a 4% desired overall risk? So it's kind of overall. You want it to be 4%, you run into this. And you do your testing and its inherent risk is 40 and control risk is 25. What does detection risk have to be? I'm going to combine these. So this is
So it would be 0.40, 0.50, 0.20 to get 04. Oh, 25.
well, no, okay, so like 40 times 25 is what? That's like 0.10. I'm just combining.
Yeah.
Let me put
So
this.
it's like 40%. I mean 0.40.
Yeah, no, you're right.
So the detection, yeah.
Yeah, so this would have to be, so the question is, what do you have to get to 0.04? And you're right, it would be, if you divide it, all right, it would be 0.40. So yeah, so this would be, let me just put it into an equation. So this will be 0.10 x equals 0.04, right? You're gonna put that into an equation. Then divide both sides by 0.10. So x equals 0.04, or yeah, so this would be x equals. Oops. Stop that. So x equals 0.04 divided by, that'd be 40%, 0.40. So yeah, this would be 0.40. So here's my point with all this. It is possible that you change your detection risk based on what you come up with for your assessment of inherent and control risk. Now, you can't actually change what truthfully they are, but your assessment of them may change based on your investigation. So in this case, yeah, what would it take to get down to 0.40? It would take a detection risk of 40%. To get down to 4.04. So it is possible, if these are lower than you expect, that you can actually loosen the reins a little bit on the audit and still have your desired overall risk. So if these, especially if they're by a lot, you know, if they're going to change quite a bit, you can change your overall audit. Probably a bad one to take because usually, you know, these two 40s are not the same 40s. But, okay. Made a mess out of that one. All right, let me move this up a little bit. Oh, still not up far enough. Okay. Yeah, so, but to answer your first question, a long time ago, you want risk to be low. All risks you want low. Ideally, they'd all be zero. It's not gonna happen, but ideally they'd all be zero. And your risk really depends on what the inherent risk is and what the control risk is. Then you can plan what your risk will be. And if you start the audit and you think their risk is something and it's actually lower, you can loosen it up. Another thing, you know, companies that are very profitable and a lot of times they have good controls, they'll audit to a lower, they'll audit to a higher detection risk. Why? Because it's less critical. Company that has poor controls, you know, or big risks, big inherent risk. Again, you have to beef it up. Okay, their controls aren't very good. We really have to look at a lot more stuff because their controls aren't very good. They're not going to catch it. So even though you don't control their inherent risk and control risk, you still use those two to determine your detection risk. And by the way, they test on this like a lot on the CPA exam about the inherent risk, control risk, and detection risk. And a lot of times, again, you know, it's important to note that these two, the first two here, you only assess them. Your assessment may change, but the actual risks themselves will not. Your initial assessment may have been wrong, but but in truth, that you cannot jump in time and change these controls, inherent risk and controls. Okay. So accepting a client is another weird thing, and we talked about this last week, I think, about the auditing profession, is that we can't simply take every client that comes to us. And notice that that's very different than other professions. You know, if someone walks into a hospital, the doctor doesn't say, well, who's, you know, does my mother work for your company? You know, you don't get that. You do get that when you're doing auditing. So there is a really different thing. And another thing is, and this is what we're going to really, they really hit this home on the CPA exam, is that you have to be able to trust the company. You know, there are requirements. You have to be able to do the audit and that you're independent and all that. But at some level, you have to trust management. If you don't trust management, the audit is, you know, the detection risk would be 100%. It'd be prohibitively expensive. And the AICPA is really big on this. The only thing we lend to the financial statements is credibility. That's it. You cannot be associated with people of ill repute. You don't just take everybody, because that would diminish your other clients and the profession as a whole if you were to take people of ill repute as your client. So it is very different than other professions in that, you know, we are choosy for a reason. The only thing we do is lend credibility. And if that credibility disappears, the CPA firm disappears. A shining example of that was Arthur Anderson and the Enron case. It was a huge fraud, okay, massive fraud. Before Enron, Arthur Anderson was the biggest CPA firm in the United States. Everyone wanted to have Arthur Anderson's name on their financial statements. Everybody. Okay, so Arthur Anderson really carried a lot of weight on their end. After Enron, okay, remember the only thing we lend is credibility. After Enron, people did not think that Arthur Anderson had any credibility. The last thing in the world they wanted was Arthur Anderson's name on their financial statements. They didn't give credibility. People looked at Arthur Anderson and go, oh, those are the people that were involved in this fraud, So it has sunk the firm. It's the largest CPA firm in the United States was sunk in about a year because of credibility. No one wanted them on their book, on their financial statements. It stood for, top of the line 1 year, the next year, zero credibility. No one wanted them. They went out of business within a year. And one of the side notes is that when it came to the law case on, Arthur Anderson, they actually won it. They won it on appeal. It didn't matter. It was credibility. The lawsuit didn't sink them. The credibility did. And so that's why, if you're wondering why the AICPA gets so crazy about, this integrity of management, integrity and all that kind of stuff, that's why. It's the only thing we give is credibility. Okay. So accepting a client, you don't just accept everybody. You go through some steps. Is a CPA firm qualified? Can the audit be completed? I should actually have those as two separate things. The CPA firm can take an audit if they are qualified or reasonably believe that they can become qualified. Oops. To complete the audit. Okay, so if they're qualified, obviously they can take it. Or reasonably believe they can become qualified to complete the audit. And they may hire people who've done these kind of audits. They may hire consultants to help them. Okay, for example, new client is an auto dealer. The CPA firm has never audited an auto dealership. here's the thing, it's kind of a chicken and an egg thing also. A CPA firm, if they don't have any automobile dealerships as clients, why would they become, experts in in auditing automobile dealerships? Right? Until you get a client, there's no reason to become proficient in auditing automobile dealerships. So what do? They can look up the literature on it, how you audit, there are specifics in each industry, how you audit things. They can also bring somebody else in who's already done it. Hey, we understand that you've done automobile. Yeah, can you come in and help us with this audit? Yeah, you can bring somebody else in who is more expert at it and more or less train you in how to audit automobile dealerships. But again, as long as you think that you can do it, you can take the audit. All right, so there's reasonable expectation. Now, if it's completely out of your league, you shouldn't do it. For instance, jewelry stores, gemologists, and all that kind of stuff. You may say, "Well, you hold two diamonds up. I don't know which one is. This one's worth 20,000. This one's worth 300. I can't tell the difference." So there are some areas that are so specialized that you may not feel comfortable doing it. But if you really believe that you can do it, you can take these audits and again get smarten up. As we like to say, smarten up enough that you can do the audit. Okay, so again, they can take it as long as they can reasonably believe they can become qualified to complete the audit. All right, I don't think I have it in here. This is really two different things. Can the audit be completed? Sometimes available information that a client can give you. Oops. Sometimes the available information that you can get from a client is inadequate to complete the audit. The example. Client only uses cash transactions and should change these. Client only uses cash transactions and nothing is recorded. One of those. I remember being in Seattle and they had a real famous fish market where people throw fish around. But anyway, a lot of times they buy these things as cash. The fish comes in, they pay whoever brings in the fish, they pay them cash, and it as a tourist, it's fine, but you got to think about it. If you were an auditor and you had to audit one of these things, it'd be really hard to do. Everything's done in cash, nothing's written down. It's all immediate. Stuff comes in, they pay for it immediately with cash, they sell it, for cash. There's nothing written down. I mean, you can check the person's wallet at the end of the day or something, but it'd be very difficult to audit something like that. And when that occurs, you cannot take the audit. And this is a big one. If you don't think the audit can be completed, you should not take it. I'm gonna put that in big letters. We don't just, and even if they beg us, oh, come on, just do the audit. If it cannot be completed, then they cannot take the audit.
Professor, is that a rule?
Yep.
Like an AI? Okay.
Yeah, if you don't think if you don't think reasonably that the audit can be completed, there's not enough information, for example, or any other reason, really. If you don't think you can complete the audit, then you cannot take it. You cannot take the client. Yeah, and a lot of times there's just not enough information. They do everything in cash. There's not a lot you can do with that. And that just may be the business that they're in. That it is all like the fish place I talked about. They throw fish around. That all this stuff is done in cash and nothing's recorded. There's nothing to audit. Okay, legal requirements. Ethical requirements. Well, first of all, independence. All chapter 3. We're not going to do that again. Chapter 3 was fun enough once, so we'll. Covered member stuff. So independence is obviously one. It could also be other clients, especially if they have lawsuits between them. So let's say you have IBM is suing Microsoft. They probably are. But or where is probably one of them suing the other one for something, I'm sure. But anyway, if you have that conflict between those two, remember you have fiduciary duty to each one of those. So this can cause a conflict that you may not be able to take one because of the other one. So lawsuits between clients, lawsuits between the CPA firm and the client. I don't know why I capitalized that. I don't know why I put an A on the end of it. Something completely different. Okay. So if you're suing the client, or if the client is suing you, you cannot take I can't take them as a client. Okay. Integrity and reputation of the client. The AICPA goes bananas over this. they would call this the most important factor. And again, why? Because all we sell is credibility, and we cannot be wrapped up in somebody who has a bad reputation. It decreases the credibility of the profession and for the other clients that are on the up and up. So the integrity and reputation of the client is one of the most important factors. Okay, we have some terminology here we have to get out of the way. Successor and predecessor. 7 o'clock here. Okay, successor auditor. This is the new auditor. So this is, the new auditor that comes in is the successor. You can probably guess what the predecessor auditor is. Yep, they're the old ones. So successor is the new. And the predecessor is the old. Okay. I'm going to add something here. Down here. The successor auditor must contact the predecessor auditor, excuse me. Successor auditor, the new auditor must contact the predecessor auditor, the old auditor. So it's maybe CPA get from the same terminology. If the predecessor exists. So the predecessor, if it's their first audit, they won't have a predecessor. Or something unfortunate happened, like the predecessor died or left the country, or whatever. That they may not exist. Okay, we'll go through these and then we'll call it a day on this one. SEC 8K report. This is for issuers only. And the 8K report is for any major change in the company. So it's not just for auditing. This is not just for auditors. So an 8K report, what is an 8K? I have an example of them. I should send that out. Yeah. An 8K report. 8K report is when anything happens big in a company, they fill out an 8K report. A company may fill out a dozen of these in a year. You sell a division, an 8K report goes to the SEC. You buy a new subsidiary, 8K report goes into the SEC. Your chief financial officer leaves, 8K report goes into the SEC. A new chief financial officer comes in, an 8K report goes into the SEC. You get the idea. Anything that's kind of big that happens in the company, immediately the SEC wants to know about it, and you got to fill out an 8K. One of those things is if you change auditors. So if you change auditors, an 8K report is filed with the SEC. Now that's only if it's an issuer, only if it's publicly traded. But an 8K report is for anything major that happens. And one of those things is if you change auditors. So if you're a new auditor coming in, you can also look at the 8K report for the sometimes they happen together, the 8K report and the new one coming in, but sometimes they happen apart. And if you do happen apart, you can look at the AK report and see if there's any problems. Okay, so what do you contact the predecessor auditor about? You know, what do you talk to these people about when you contact them? Again, the biggest one is going to be integrity of management. Reason for change in auditors, why did they, did they leave over a dispute? Is it something they just, sometimes you have auditors retire. Oops. Experiment, lost license. So there could be any number of reasons why. See something here. Why they changed it. Disagreements with management. Any communications with them, with either anyone in the company, basically. Related party transactions. Okay, now. And I'm gonna put one more thing in here, and then I'll stop here. Let's go along with this. Remember, you have a fiduciary duty to the client. And this doesn't stop when you are no longer their auditor. So the client has to give permission to the predecessor, the new auditors coming in, to contact the old one. So when the old one's contacted, the old one will say, well, okay, well, get a release so that I can talk to you about, the client. So let's say it's IBM. So I'm the old IBM auditors. They bring somebody else new in. I cannot disclose any information to those new auditors unless I get a release from IBM. It's fiduciary duty, the fiduciary information that I have to protect them, even if I'm not their auditor at that time. So you get cleared by the client. So the client must give you permission to
So we can't see your the screen you're typing.
Sorry, bad ventriloquist static. All right, yeah. So the client, thank you. So let's say IBM. Oops. Okay, so let me clean this up a little bit. So the client, let's say it's IBM, must give permission to the predecessor auditor. This is the old auditor to share information with the new auditor. So the client must give the permission to the successor auditor. Now, suppose you have the client says, look, that previous auditor, those guys are just a bunch of jerks. I don't want you talking with them. If it costs a little bit more money, that's fine. I'll pay the extra money. I don't want you talking to them. They're just a bunch of idiots. Is that a problem or not a problem? You know, if the client does not give permission to for you to talk to the old auditors.
That seemed like that would be a problem because it might be trying to hide something.
It's a big problem. Whenever anyone tries to hide, tries to not allow you information, it's a problem. This is what they would call, contact is what they call a scope limitation. You can't look at stuff that you need to. And this is, the scope limitations are always taken very seriously because you always wonder, why don't you want to do this? Even if you were mildly interested before, once someone puts a scope limitation on, you're now very interested, in looking at it. So a scope limitation is such that if you cannot contact the predecessor auditor, generally speaking, you don't take the audit. So if you cannot speak with a successor auditor, now it is possible that there are circumstances that you can't do it. Whoever the successor auditor died, the successor auditor left the country, they're in the hospital in intensive care or something. There are reasons why logistically you can't do it. But if the predecessor auditor is available, you must do it. And whenever a client puts a scope limitation on, it always raises your concern because, and maybe they were jerks, it happens. But it always raises your concern because it's kind of like if you're doing a murder investigation, you come to my house and I say, okay, yeah, you can look at anything in the house, but not in this closet. Well, first place you want to look is in the closet. So whenever there's a scope limitation, it always raises your concern that there might be more on it. Okay, let's go ahead and I went over. Let's stop here. And let's say be back at 7:18. Let's say 7:16. How about that? And I think what we'll do, we'll finish up the monetary unit sampling, and that's all we're going to finish up. So if you want to pull up the next thing, we're going to. That's not it. I'm not sure what that is. So if you want to pull up the monetary unit sampling, this will be the next thing that we go over, and I think we get in number 6. In fact, I'm going to transfer my stop be back onto this one. Okay. So obviously we're not going to finish the chapter 6 handout tonight. But hopefully we'll finish this one. Okay. Okay, excuse me. So number 6 is where we stopped last time. So let's get going back on this one. So this one. Risk correct acceptance is 10%. And the book value is 2 million. Okay, so coming down here, I should give these some kind of a the first one. What do we do with the first one here? You know, we should probably do is kind of look up here to this one. These first 3 are what I would call kind of well-behaved items we found. In that the book value, well, first of all, they're overstatements, right? We're saying it's 14,000, they're saying it's 20,000, they're overstating this account. So these are overstatements. And the book values are less than the interval. So as long as they are overstatements and the book values are less than the interval, they're kind of well behaved. They're what we normally think of when we find something wrong. Understatements, if the audit value is higher than the book value, we ignore it. This method is not supposed to catch them. And again, this kind of as an auditor, this kind of goes against your grain, but you find this error and you don't do anything with it. So if you find an understatement, you know, we're saying it's 2,600, we're saying that they're understating it by what, 700 here? We ignore it. There is no problem. Okay, so it's not supposed to find understatements. When we do find them, we ignore them. Another wacky thing is if the book value is higher than the interval, it does not go in the incremental allowance because that interval cannot be any worse than it already is. This book value covers the entire interval. Incremental allowance is only for those things that can go more wrong. You know, if you run into an area, you go, okay, well, this could be worse, right? If you run into one area, you could have more. Down here, because it's limited to this interval, there can't be any more in this interval. That's the entire population is covered by your one item. Can't go any worse, so it is not included in the allowance. And again, even if they get really big, this one crosses 2 intervals, maybe even 3. Same idea, that it covers the entire interval. Okay, so let's go down here. This first one, I'll tell you right now, it's an odd one. What's wrong with the first one?
The audit value is more than the book value?
Yep. This is an understatement. Oops. So this is an understatement. We ignore it. So projected value would simply be the whole 100,000, and there would be no misstatement. Again, we don't do, quite honestly, we don't do anything with it. it wasn't supposed to find it. When it does find it, we ignore it. There is no misstatement. It's not gonna be an incremental allowance, and even if it was, it wouldn't matter because it's zero. Zero times anything's gonna be zero, so. This first one here is really not a problem at all. Second one here. This one is a little bit better behaved. Notice that it's an overstatement, right? The audit is 15,000, the book value is 20. So this is an overstatement. They're overstating it by what, 5,000 or whatever. And the book value is less than the interval. So this is what I call a well-behaved. All right, so. 15,000 divided by 20,000 is some number. 75,000, right? Should be able to do that in my head. Okay, so the projected misstatement on this one would be what?
Is it the 75,000 minus the 100,000?
Yep. 25?
Mm-hmm.
Okay. All right. I guess we can do the incremental loss now. The 20,000 is less than the 100,000, so there still could be a lot more wrong in this interval, right? This is. The book value only covered 20,000 of the 100,000, so there could be something more wrong. So is it included? Yeah, because there could be more things wrong with it. Second one is a wacky one, or no, third one. I should give these numbers. I don't know. So the third item that we found, what's the problem with this one? The 95 audit value, 108,000 book value. What's the problem with that one?
The book value is more than the interval.
Yep. This covers the entire interval. So we actually go to the actual misstatement for this one. So it would be 108,000. Minus 95,000. Equals 13,000. Oops.
Yeah, that's
Is 13.
yes.
Okay. So this will be our projected misstatement. Now, oh, wait a minute. I lost a zero off that one too. Now, here's the thing on this one though. This cannot get any worse. This 108,000 completely covers the interval of 100,000. This one, while it is a misstatement of 13,000, the actual misstatement is 13,000. It is not in the incremental, and it's not in the incremental because it covers the entire interval. There's nothing else in that interval could be wrong. You got to think about these intervals almost as like entire populations for the item that you're picking. So this is the entire population for this. This is the entire population for this, and this is the entire population for this. So you got to kind of think about them in that, in that context. Okay, so projected misstatement, 25,000, 13,000. Coming down here, again, this is what I would call a well-behaved one. In some of the literature, they'll tell you you have to look into why it's 0, which you should do anyways. Not sure why they sometimes say that, but so if they have something on the book for 12,000, that really should be 0. The projected value is 0. And so the projected misstatement would be what?
$100,000.
Yep, very good. So the whole thing is misstated. They have the thing on the book for 12,000 and it's 0. And again, some of the literature will say, look into why it's 0, but you should be doing that anyways, whenever you look into any of these. And will it be included? Yes. It will be included because a lot more could go wrong in there. This is only for 12,000. There's another, 88,000 still left in that population. Okay, so to recap here. The first one, it's not a misstatement at all, so it doesn't really matter, but is it including the incremental allowance? No, it's not a misstatement. The second one is, again, this one's kind of well behaved. It's book value is less than the interval. It's an overstatement. Next one, the third one, is an overstatement, but it's bigger than the interval. So nothing else in that interval could go wrong, and we simply take the actual amount. So this is the actual misstatement. So they said it was 108. We say it was 95. The actual misstatement is 13,000. That's what we take and put it over here. And nothing else could go wrong in that interval. Covered the entire interval and then some. So nothing else could go wrong. Down here, again, this one is also well behaved. Again, some of the literature will say check on why it's 0, which you would do anyways, but regardless. So this is direct value 0, and the entire thing would be 100,000. So projected misstatement will be all those together. 28, 138. They want to check that. Okay, basic precision. I'm going to come all the way down here, blah, blah, blah. Basic precision equals the interval times the reliability factor. And I think on this one, it was, I think it's 10%. markup. Ah. Okay, that's kind of huge. Okay, basic precision equals the interval, which is what?
100,000.
Yep. Times reliability factor, which I think was 2.31. Again, that's 10%. Basic precision, 2.31. $231,000.
Yes.
Okay, so this is. So 'And the basic precision is if nothing, if you didn't find any problems, it's still a sample and there still could be things that are wrong. So basic precision really means that if nothing goes wrong, this is how much you'd have to allow for, because it's a sample. You didn't take 100% of the items, you took some, a fewer amount. So it is possible that it's off by another 231,000, not because of any errors, but because of it's a sample. Now, incremental allowance says, oh, we must have already done these, at least the intervals. Wait a minute, those aren't right. No, they're not right. I'm sorry. Let's we're at 10%. Must have just copied it now. Okay, so I'm gonna copy these up there. So at 10%, these are the intervals. I was thinking like that. Ah. Okay, new plan. I'm just gonna type these in. So 2.31, 3.89. And see, this would be a very easy table to make separately. Again, if I ever get a book. Okay, so these are the overstatements. So for the first one, overstatement 1 is 3.89 minus 2.31 minus 1 equals another 0.58. Okay, overstatement 2 is 5.33 minus 3.89 minus 1.
0.44.
44, okay, so that would be, 44,
Yes.
okay. And 776 minus, Wait.
0.36.
what did you say it was 36?
Yes, 0.36.
Thank you. All right, so these are the incremental amounts. And again, this incremental amount says this. If you do find errors, that means that there may be more errors in these given samples. You know, these, think of these, each of these intervals are like a given sample. And two of these could be worse. This one can't be. We took 100% of the sample, we found out it was off by 13,000, so it's just off by 13,000. But these other two, 25,000 and 100,000, there could be more stuff in there that's off. So 25,000 and 100,000, we would do the incremental allowance, saying, okay, there could be more things off in those two. So which one is the largest of the misstatements? We have 25,000 and 100,000. Which one's the largest?
100.
Yep. Yeah, the 100,000 is going to go first because it's the biggest one. Oops. So we've got 58,000. And obviously the second one will go. Second. 25,000.
11,000.
11,000. Okay, thank you. Both these. Okay, so, and there is no third one, so we can just stop here. $69,000.
Yes.
And again, this one is there because there's because there are error founds in it, there is more likelihood that there's more things that are wrong with it. I got all kinds of different fonts in here. Okay, so I'm going to copy these down to here. Let me get rid of these. I guess I'm not. Okay. Let's try this again. It was fun watching me learn how to use a computer. It's a hoot. All right, so let's see. Oh. And let's go to C. We add all of these up. Okay, I guess we can And this will give us our upper limit. In other words, what we think that it could be off by. Total. I think it's 438.
Yeah, 438.
Okay. Oh, let's try that again. We have 4 there. Okay. So this is the upper limit of what we think it can be off by, and the question is that material? Well, the accounts receivable are 2 million. I would probably say that would be material. I don't know the circumstances, but if you have something on account for $2 million and it's off by close to $500,000, it's probably material. But again, that's a judgment call. Is it material? It probably is.
Professor,
Yeah.
can you go all the way back up? Just 1 second.
Mhm.
To the first problem. I think I missed something the last time.
Problem
Oh,
5.
yeah, you could go down to where we were. Right there. Okay.
Yeah, and these reliability factors, there's no reason why they couldn't have a table to have all those. I mean, it's simply taking from the same table and rearranging the numbers. Maybe I'll just end up making one of those myself. It's not that big a deal, but yeah, kind of a wacky.
I got it. Thank you.
Yeah, there is an eloquence of using just one table, but at the same time, it's like, why jump through all those hoops? Okay. So let's go comparison of monetary unit sampling and classical sampling. Okay, so we've covered both of them, and monetary unit sampling. It could be called dollar value, it could be called probably proportional size. I don't know if I even dollar unit sampling and monetary unit sampling obviously are very similar. Dollar is a US monetary amount, whereas it could be anything, this could be in euros, this could be in British pounds, it could be in Australian dollars, it could be in whatever. But there is a beauty to it that I don't think I mentioned. And that is, when you talk about these intervals, this method is, it counts every dollar as an individual item in the sample. So when you talk about an interval that is $100,000, you're talking about 100,000 items. Every dollar is an item in the sample. And there's a beauty to that because each dollar is worth the same amount. If you were to actually line up, when you talk about, like, if you in regular audit, regular statistics, you talk about your standard deviation. How much does it deviate from the average? Is it a lot or a little? For this method, the deviation is 0. Why? Because every dollar is worth $1. What's the average of 100,000 items that are all valued at $1? It's $1. Nothing deviates from it. So it is kind of a unique kind of a sampling thing that it's way different than most sampling you think of. The nice thing is, if they have a lower occurrence of misstatements, you can a lot of times take a smaller sample size. And this is kind of the big push for it, is that you can take a lot smaller, and sampling really costs a lot of money. So if you can reduce the amount of sample size, you can reduce how much an audit costs, you can make an audit quicker. It can be more efficient. And again, if there's low rate of misstatements, a lot of times you come up with a more efficient audit. Automatically stratifies a sample. Larger items are more likely to get picked. We saw that. Well, I guess we saw through the whole thing. For instance, well, here, let's go to the last one we just did. That's not the last one. For this one, if you make it large enough, it's 100% it's going to get picked. So it automatically picks the larger items in general. Yeah, does something that costs $3, can that one be picked? Yeah, it can, but it's just much less likely. So it automatically picks larger items. They call it stratifications. Actually, we'll talk about that in the overview tomorrow, or not tomorrow, next week. And generally, even though you wouldn't know it from what we did today, it's easier to use than classical sampling. There's a lot less hoops to jump through for monetary unit. Disadvantages, and a couple of them that are big. Cannot be used for understatements. In fact, it's so bad at understatements, we ignore them. So if you think there's going to be an understatement, if you think the accounts might be understated, this is not the method to use. And the sample size is not easily expanded. And what that means is that if you do run into a problem, you'll notice something. The sample determines the interval. The sample size determines the interval. So if you say, okay, well, so let's say you run into a problem. Okay, like the one we just did, they're off by $500,000. Now, before you go accusing your client of fraud, you're probably going to look into it a little more. Say, okay, well, let's really, we audited this to the 90% level. Let's audit this one to the 99% level, because I don't want to go in there and tell them your books are off unless we really know that they are off by a lot. Okay, so how do you expand the sample? The problem with doing that in monetary unit sampling, when you change the number of items you need to pick for the sample, it's going to change the interval. You're going to pick different items. So because of that, it's not a really good one to use if you think there's going to be a problem, basically, because again, like anything, you come up with a problem, you want to make really sure that you have your ducks in a row when you go talk to the client, because it could get ugly. You tell them their books are off by $500,000, and they look at you and say you're nuts. It's not off by $500,000, no way. So you better have your ducks in a row. And again, it's very hard to increase that sample. Okay. Classical sampling, which we covered before. If you have a lot of misstatements, it is a better one to use for a number of reasons, but if you have a lot of small misstatements, the classical sampling is one to use. You know, especially if they're random misstatements. Some are overstatements, some are understatements. You know, but on average, it's okay. It's a good one to use, the classical sampling. Items with negative balances do not require special consideration. We didn't talk about that, but if they have negative balances, you can in classical sampling, you can simply fold them in with all the rest. Truthfully, in a lot of the stuff, it involves a reclassification, but anyway, if you keep them together, that you can do that. This is the big one, can be used for understatements as well as overstatements. So if you come up with an understatement, you cannot use monetary unit sampling. And the sample size can easily be expanded. If you need to take a bigger sample, you simply go back to the random number table, pick more random items and run a bigger sample and get a better reduce your allowance, basically. Make it a tighter sample. Disadvantages: estimated standard deviation must be calculated to determine the sample size. So this is, you have to do some work ahead of time before you even get the sample size. You know, you want to know how many items to pick, you got to actually go out and take a sample to get a standard deviation to make a sample size. Stratification may be needed, and we'll talk more about this next class. You may want to look at larger items more than littler items. And just in case you're wondering, that is not how you spell Dan. I guess it makes a difference with order. Oh, that's not how you spell it either. Okay, I showed you the two different ways to misspell Dan, so you know not to do that. Okay, so for instance, you might take items that are larger than $100 or $10,000 might be chosen. So stratification is, there's some items that are more important than others. A $10 item you probably don't really care too much about, but a $10,000 item, you know, you're talking real money, and you may want to look at that. And this is important, and this is kind of different than back in my day. The auditing standards do not advocate one technique as being better than the other. Simply used in different circumstances. A very large thing is for understatements and a higher occurrence of misstatements. These are kind of the two factors that really play into these. If you think there's gonna be a higher number occurrence of misstatements, or if you think it's gonna be understated, this is the method to use, one of the classical sampling ones. Okay. Yeah, that's it. That's a long one. Okay, so next class we're going to we'll do the I sent out the classical sampling, or the sampling overview, which we obviously are going to do tonight. But next class we'll do it. I'll send it out again next week. So what do we turn into now? Oh, the monetary unit sampling one we can turn in tonight. Do I have it here? I don't have it. Okay, well. Huh. Alrighty. I have to add that in, so I'll add the drop for the metric sampling. And I don't, so there's nothing else to turn in, so the metric unit sampling one will be due on the 21st. And I think there's is there a test due this Friday? I think there is. But anyway, so I will see you guys next week, and the monitor unit sampling, I'll have that assignment up in just a moment. And any questions?
No question.
Had enough. All right, well, I think we all have. All right, well, I'll see you guys next week. Good night.
All right, thank you, Professor. Have a good evening.
See you next week.
Bye.